Okay, let's answer some questions from the last weekly outlook. And before I start, just a reminder that on Sunday at 6 p.m., that is New York time or Toronto time if you're in Canada and you think better in Toronto time. 6 p.m. I will do a live YouTube feed and I'll answer questions. And this will be focused purely on the market and issues or questions you have about different aspects of the market. It won't be CFA related. For those of you who are looking at the CFA program and looking for a provider, you can find me at my name, markmeldrum.com. As you know, I've removed advertising from my videos, and in exchange for that, you're going to have to put up with me promoting my other business for the first 30 seconds or a minute of every video, right? Give a little, get a little. All right, let's begin here. Some good questions this week. With many countries showing signs of decoupling from the U.S. and the closing trend of the interest rate hike cycle, do you have any suggestions for how to hedge against U.S. currency risk? Well, I don't know that you require all of those assumptions to get to a conclusion of how to hedge. How to hedge is easy. If you are long U.S. dollars, in other words, you're holding stock, let's say, or you're holding bonds that are denominated in U.S. dollars, and you want to convert it back to your own currency to hedge, you just have to sell U.S., which means find any forward contract, make sure it's in the right direction, whether it's an indirect or direct quote on the forward contract. And the idea that you're doing is you figure out, well, what is the sum total of all of the dollars you have, and then you can use a forward contract to hedge out. I don't know that we have to make to say, well, because of this decoupling and the end of the interest rate cycle, that hedging would be any different. It wouldn't be. It would be the same as any other time. Could you also recommend a few of the most accessible ways for retail? And then notice every now and then YouTube gives me like 3 dots but won't give me the opportunity to expand. Other times they do give me the opportunity, because you can see here I can click on show less because I've clicked on show more. Don't know what's going on there. Futures contracts are the easiest way to get that done. Let's see, just wondering how you would interpret the unemployment rate data, given that there is an increase in participation rate, but yet the unemployment rate is lower than the previous month. That's because the number of new entrants into the labor force were smaller than the number of people who got a job. So let's say that you have the labor force increased by 500,000 people, but that 700,000 people got a job. Well, the people coming in took 500 of those jobs, you could argue, and still the existing people, 200,000. So if you have more jobs being created than people entering the workforce, then the unemployment rate would go down. Are you expecting that the trend of participation rate to move higher? Well, purely from an economic perspective, if we talk about supply and demand in particular markets, as a price increases, the supply should increase. And the supply, here we're talking about the supply of labor. And labor is supplied by households and it's demanded by firms. And that's a factor market called the labor market. And if the price in the labor market is rising, we would expect that there'd be lower demand from firms and higher supply from households. So I think it will continue to rise to the extent that the population allows it. How much more? I don't know. I don't think we're going back to 67, 68% participation rate, not without a significant increase in immigration, though. As a long-time stock picker, I'm starting to become interested in the flexibility options can provide. I'm planning on starting slowly to learn a bit more. First idea is to use a long-dated TLT call, funded by a short put, and hopefully sell the put later for a free ride on the call. Okay, so that's what I've been doing over the last little while. I had bought a January 2024 110 call months back, and then I've been selling shorter dated puts against it to eventually get it for free. And basically, I more than got it for free now because I sold a 115 call against it to create a 110 to 115 bull spread. So I know what you're trying to get done here. I have high conviction the U.S. will enter a recession inside the option expiration period, but conscious an upside CPI print may screw my plans. Well, listen, if you get an upside CPI print, it just means that interest rates will be higher for longer. I don't know that given the banking situation we had a little while ago, I don't know if 5.5 or 6% is in the cards for the Fed. And if you still believe that we're going to have a recession, that would be the trend that you're playing. A hot CPI report would be what's called event risk. And we trade events, but we invest in trends. So the trend is that you're expecting is a recession. And the event is, well, maybe the position might move against you in the short term. Yeah, it just might. So what I would do is I would have patience. You wait for a sell-off. You wait till there's weakness in TLT, then you buy your call. And then you wait. If there is more weakness in TLT, then you can sell your puts at a lower strike. If there is strength in TLT, it'll start going up, and your call will start making money right away. I like the idea of hitting easy singles rather than home runs, and that's the name of the game. Get on base. Every trade should be about getting on base, because if you swing for the fences all the time, you'll probably have a lot of good winners, but you'll also have a lot of strikeouts. Every home run king. Look at the Major League Baseball. Look at the top 10 home run hitters. The top 10. They're probably also the top 10 strikeout leaders. So when you're dealing with real money, there's only so many strikeouts you can have before you're out of the game. Can you recommend any academic papers that attempt to explain why recessions have always followed a 3-month 10-year inversion? None come to mind. But typically what happens is you get an investment recession. And that's kind of one of the most insidious types of recessions, because it doesn't show up too much in the negativity for GDP, but it hollows out future growth. So let's just think about what's going on here. So you have a curve that looks like this. This will send money into money market funds because you can get a higher rate than what a bank is willing to pay. And as money is leaving a bank has to balance its banking book every day, which means assets have to equal liabilities. So if you have deposit outflows, you're going to have assets greater than liabilities, because these are your loans, these are your deposits. So you're going to be stepping into the wholesale market to cover off your liabilities every day. Well, you're stepping in at these high rates, but you're lending at these rates, high rates, low rates. So it slows down credit. Now what the bank will do will say, well, if that's our funding rate, and the formula for it is a little, not complex, but complicated, so I'm not going to go into how they calculate what their lending rate is, but they engineer an upward sloping curve. Well, it's still going to be a higher rate for lending, which means fewer loans are being made. So what happens if you look at GDP is the I component of GDP, the fixed investment part, will start to show negative. And the more negative, and this is the most variable part of GDP. So if you're looking for, in terms of what is the most variable component, it is the I component. If that stays negative for too long, well, that is investment in future growth. You hollow out future growth. So the recession may be shallow, but the climb out of that recession will be long, because you haven't made the investment in future growth. So you could have this long, protracted a sort of bear market where earnings just have no growth to them, or they sort of just decline. Go back to 2000, and that is exactly what happened to the S&P during that period of time. The recession wasn't that bad overall, but it hollowed out investment big time. And because of that, the S&P, I think, was from peak to trough 50-60% down from peak to trough, and it lasted 2.5 years. It was a huge loss of investment wealth with not a very big drop in GDP. So that's what happens when you have an inversion from money market to capital market, is because banks' funding costs are money market rates, or at least interbank rates that are basically set close to where the money market rates are because they are a function of the interbank rate. But you have a deeper inversion of the curve such that if you're lending out 5-year, 10-year funds, the 10-year rate is so much lower. So it squeezes net interest income, net interest margin, and given the risk inherent in loans going into a potential recession, credit pulls back quite a lot. Let's see. 2 questions. On the equivalent effect of QT for tightening, as you described, can we say that the yield curve is somewhat distorted as a result of QT? It is not currently as inverted. Well, they're not a buyer, so you would say it will probably be more inverted because they're not rolling over by buying. I don't know that I would say that it should be more inverted. I try to come up with a bullish thesis. If, as many suggest, the upcoming recession is going to be short and shallow, why not give lost the rest of that? And I think what it said is why not give the market the benefit of the doubt and look past everything to 2025? Is because let's say there is a recession. Well, you don't know what conditions the recession will create for the next growth cycle. Is it going to, if you have a recession in which it's just investment led, the Fed is not going to lower rates to the zero line. The Fed's only going to lower rates to the zero line if something really significant breaks, and that's usually in the credit markets. Powell, even before he became the Fed chair, argued and was arguing that the zero line is temporary. It's not that high rates are temporary. It's not where we are now is temporary. He argued that the zero line is temporary. All of that stuff was temporary. So unless something really breaks, the Fed's not going back to zero. So if the Fed's not going back to zero, you're going to have a permanently higher cost of capital. That's what you don't know. You don't know what you're looking forward to. So if you look past all of it to 2025, what exactly are you looking past? What type of recession are you looking past, and what will the environment be? We're not going to know what the environment will be until we actually have a recession, and if we don't, it'll be a permanently higher cost of capital environment that we're in with lower levels of liquidity. So that is not a growth environment. So yeah, you can look past it, but are we looking past and thinking 2025 will look like the past? Hey, let's get back to 2016, 17, 18, 19. That's where we've come from, is where we're going. We just got to get past this. Well, we don't know. That's the thing. Looking past something is, but what if that event changes the environment going forward? You won't know. We don't know until we know what kind of recession it's going to be. The best thing for markets is a brutal recession, is one that is deep and fast and everything breaks apart and you have to go back to the zero line. That's the best thing for markets. The worst thing for markets right now is no recession because you're going to have margin compression going forward. And if you have no recession, where's growth going to come from? Because there will be prolonged underinvestment, which means you're looking at stagnation in economic growth or meager growth. And if you can't get the job market off of 3.5%, the Fed's in a tough place. I believe this Fed is more concerned about being a central bank for society and not being a central bank for Wall Street. Because really, from 2009 to heck, just until they started raising rates, they were Wall Street's central bank. They backstopped the markets. That's where you get the idea of the Fed put. They were Wall Street's central bank. I think that this Fed is far more concerned about being society's central bank, and that Wall Street's smart enough, they'll figure out how to move around what we do, but we're here for society at large and not Wall Street anymore. So I wouldn't look to the Fed to be that friend. So a lot there. I don't know if that answered your question, but I wouldn't look past anything right now. I had a question about risk management with respect to your SPY factory from the Applied series. That SPY factory was, and if you watch that video again, had an assumption. You have to have an assumption about what the market is doing. And the assumption was if you feel that you are in a confirmed bull market, that SPY factory is an excellent tool. Or I don't feel we're in a bull market, I would not do a SPY factory on that. How do you do risk management when the market falls 5 to 6% 3 or 4 times each day in a week, as they did during COVID crash? You don't, you can have a strategy. So let's say short straddle, where you sell a call and you sell a put, and you're selling it at, let's say, 20 delta on each side. Not every stock is a candidate for a short straddle. There are certain kinds of stocks that work well for short straddles, and certain environments in which those stocks work well. So, the risk of showing you how to do an income factory or an allocation factory is that you think that you can do this all the time. But there are certain market conditions under which an allocation factory makes sense. There are certain types of market conditions under which an income factory makes sense. And depending on the market condition you have, the type of income factory you would use would change. So it is not a, no matter what's going on, use it, that sort of thing. So I think we can move past that one. On the last live CFA Level 2 Q&A, I posted my question in advance. Okay, that's a CFA question. We'll pass on that. I will say that if you're watching this and this is your question, if you just rewatch the session I did, I know it's long, but it's got a lot of good stuff in there. I probably answered this question. I was reading Agency's 10K, but I didn't understand quite well the 30-year current coupon MBS. And keep in mind now, that is a 30-year MBS, which is the most common MBS sold. There are 15 years, but 30 years is the most common one. That is a security, a mortgage-backed security. That is not the rate on a 30-year mortgage. It's the yield on a 30-year MBS. And if you go to CME, you can find all of the different MBSs, and they all have specific coupons. There's the 2%, there's the 2.5, the 3%. So they're all sold within a family of coupons. So you can find all of the listing for the current prices on MBSs. My understanding is that the equivalent is the equivalent of the par curve for bonds, but applied to MBSs. Yeah, you can get that from CME. As the coupon rate of the MBS trading closest to par. In the chart, they posted the spread between this and the 10-year was 160. That's the spread between the 10-year and the MBS. Mortgage News Daily, the 30-year fixed rate mortgage. Now, that is a mortgage rate. This is an MBS, which is backed by mortgages. So let's say that you have a pool of mortgages, and the average mortgage rate in here is 6.5. Well, you can't sell an MBS at 6.5 because there has to be something here for the servicer. 75 basis points, let's say. So your average coupon over here might be 5.5%. If you have 6.5 over here, 5.5. There's money in here for the servicer of the mortgage, and there's extra money in here as a credit enhancement. In case some of the mortgages default and there are losses, there's money that builds up because of the extra spread. So the mortgage rate has nothing, well, I shouldn't say it has nothing to do. The mortgage rate will be higher than the MBS yield, which is higher than the 10-year spread. So here they're saying if you take the 10-year U.S. Treasury and you add 160 basis points on, they're getting to that 30-year MBS. And then if you add some basis points on here, you will get to the 30-year fixed rate mortgage. So there's a spread between the MBS and the fixed rate mortgage that represents, on average, the level of servicing and credit enhancements taken as part of that spread. And then this is the spread here that mortgage REITs are sensitive to. I really just measure this spread here because it gives me a good proxy as to what this spread is, because you can't always, this is the MBS are quoted in prices, not yields. So you have to do a lot of mathematical gymnastics to reconvert that into a yield, which I'd rather not do. So since it's quoted in prices, I just figure, well, if I see the spread between a 30-year fixed rate mortgage and a 10-year treasury decreasing, I have a fairly safe feeling that the spread between the 30-year MBS and the 10-year treasury is shrinking as well. Let's see. Where would I find the 30-year current coupon MBS rate? Well, it doesn't quite work that way. There are certain types of coupons that they're issued with, as opposed to having all these different coupon rates that exist, 5.2%, 6.4, 3.9. There are families of coupons that exist. But you can find a lot of that at CME. Just now, Wells Fargo wrote that they are waiting for a 10% correction on S&P around 3,700. I am one more person you have convinced to get the CFA designation. Besides that and money that may come from this path, what was the constant motivation to have a continuous effort to learn more? Well, when you love what you do, it's not hard to convince me. Even as a young kid, I knew I loved school. I was always at school. I remember one day there was a blizzard and school was canceled. I still walked to school thinking, well, there'll still be some class, right? Some people will show up. I still went to school. It was just my thing. So, and combine that with my addictive personality, because I do have an addictive personality. When you like something and you have an addictive personality, it becomes all-consuming. It's everything you do, and then you can't imagine doing anything else. If I quit now, I would have to find an FA program, which is a financial anonymous. Hi, my name is Mark, and I'm a financial addict. I would have to find something and go into rehab because the withdrawals would probably kill me. For your US 10-year to 30-year FRM, I'm not arriving at the same spread. Keep in mind the 30-year FRM is Thursday over Thursday, which means you have to use the Thursday over Thursday spread on the 10-year, not the Friday over Friday. You have to back up one day at treasury.gov. When you have the list of all the yields, you have to go back to Thursday and then look at the difference in the 10-year over the last Thursday. It's Thursday over Thursday. TLT is down 1.5%. The Ultra 30-year down 0.54. Ton of divergence going on here, but it's tough to gauge. Looking at the chart with the secondary axis and IB, it has a correlation change quite significantly depending on the window of observation. Well, TLT isn't going to track exactly what the futures are doing. Keep in mind the futures have a decay every single day. They have positive carry, so every day that positive carry gets less and less and less and less. So there are times where the carry for the weekend comes out all at the same time. Either it comes out Monday or sometimes even late Friday. The carry for the whole weekend will come out. So you get 3 days of carry that disappear. So when you're looking at the bonds, you're looking at the futures. And you have to go to CME and look at what the underlying of that happens to be. Because the futures have that carry and they decay every day. So you're not going to have a perfect correlation with TLT. And yeah, there are some days where it tracks fairly closely with the moves in the futures, and there are some days that it doesn't. Also, the futures will change in price on a coupon date quite significantly because the futures price subtracts out the present value of the coupon. So as each day goes by, the present value of the next coupon gets lower and lower, but the accrued interest gets higher and higher on the dirty price. So until you actually hit that coupon date where there is no accrued interest, and then in the futures period there may be no future coupon, you can have these price changes on the futures that aren't mapped on TLT. What are some indicators to look for to know when the next business cycle expansion is happening? You would have small caps that are outperforming large caps. You would have an expansion of credit, which we do not have right now. Typically, you have an upward sloping yield curve. It's hard to imagine a new expansionary cycle happening with an inverted yield curve because that constricts credit and it constricts investment. So it's just hard to imagine how you can get that with an inverted yield curve. So typically, you have a very steep upward sloping yield curve. You have expanding fixed investment. And you have small caps that are outperforming. You have, what else is going on? You have employment that tends to be, the unemployment rate starts to come down. Well, we're already at a high rate. So, all of these indicators right now suggest that we are facing a contraction or heading into a contraction that we're not these are not conditions under which you would get the next expansion. About commercial real estate, is multifamily housing part of it? Probably not. I think multifamily housing will hold up better because there is a shortage of housing and people have to live somewhere. What I don't like about multifamily housing right now is where's rents going to go, because the upside of the valuation, especially property value, is increasing NOI and a decreasing cap rate. Well, you don't have increasing NOI, you're probably going to have flat NOI for a while. The cap rate is R minus G. Well, unless rates drop, R minus G is not going down. And if we are entering a slow growth to negative growth environment, G is going to get closer and closer to zero. So your denominator being R minus G, your numerator being NOI, I see that being flat. So that means the denominator has to do all the heavy lifting, which means either R goes down with a constant G or G goes up with a constant R, or a combination of the two. Without a recession, I don't see R going down. And if we don't have a recession, I don't see growth accelerating. I see very low growth, so G will be low, which means your denominator is going up, your numerator is flat, and that is how you calculate property value. So without this moving, I don't see property values moving. I don't see them cratering, but I just don't see them. I don't see the upside right now. Can ABR be affected by a possible credit crisis in CRE? Anything. And there'll be no distinction made at all if you are in the credit space in the least. If there's a credit crisis, everything gets thrown out, period. What is your opinion on the introduction of a 40-year mortgage? Well, I mean, we know that consumers do this, right? So when we look at cars and we look at houses, oftentimes the sticker price isn't as important as the monthly payment, right? So if you are selling a car, what you advertise is the monthly payment they can get. There used to be 5-year car loans. Well, there are 7-year car loans now, just to get that monthly payment in where you need it. Canada, I think we have a limit on 25 years for a mortgage. I don't think we have 30 years. In the US, there are 30 years. In Japan, there are 100 years. So the introduction of a 40, if that's what it takes to get the monthly payment in where you need it, it's sort of just a financial innovation that says, hey, hang on a second, I know how we can sell some mortgages. The question will be, will these be agency qualified? Will Fannie and Freddie buy 40-year mortgages and sell them in MBS? Will there be a market for that? And if there isn't, that means the originator has to hold it on their balance sheet, which uses capital. So you are going to have to, that's a big maturity mismatch to have on your balance sheet between your liabilities and your assets. So sure, you can introduce a 40-year, but who's going to finance it, right? Where's it going to sit on? Whose balance sheet is it going to sit on? And are we going to see MBSs backed by 40-year fixed-rate mortgages? For the live next Sunday, can you move it 3 hours before? Not really. In the middle of the day, it's going to be hard to do because I also do other things, right? So Sunday at 2 p.m., if you're a level 2 candidate on our site, Sunday at 2 p.m., that's New York time, or Toronto time if you're in Canada, I have the second derivatives workshop for level 2. That's at 2. Those last 2.5 to 3 hours, so that could bring me to 5. So there's just no way that I can move it. That gives me an hour to rest my voice for 6 o'clock. I do quite a few of these depending on if it's the applied series, depending on if it's just live Q&As for CFA, whether it's office hours for CFA. So when I set a time for something, it's just, that's my schedule. Let's see, where are we? With your thesis on the financial sector, not achieving the estimated 20% earnings growth, is there a reason you aren't taking advantage of this by selling calls on IYF or KRE? Or do you have a reason to? Well, it's because it's going to infect everything. What I've noticed is there's very little diversification I can find right now. The only diversification I can find is between long and short positions because they typically have negative correlations right now. But I've noticed that if you let me look at just one thing, let me look at where the peso is or where the yen is, I can tell you where the market is, I could tell you where oil is, where gold, I could tell you where everything is, because everything seems to move almost in lockstep right now. That there isn't 5 different trades in the market, there's really just one. It comes down to one thing and one thing only. Everything moves with beta. Everything is moving with beta. So I don't really need to look at everything anymore. You only need one indicator. So when I think about all the opportunities on the short side, it all comes down to one thing. It's like, yeah, but if that drops, it means the market's dropping. I may as well just be short beta. And if this drops, it means the market's dropping. I may as well just be short beta. So rather than being short 5 or 6 different sectors, I figured, why not just be short one? And so that's what I do. And it's easier risk management when you concentrate it that way. How do we come up with capital market rates? You get that at treasury.gov. Right? Treasury, oops. So it does this every now and then. Let me just hit pause, and I will restart the video. All right, I'm back. I had to close Sketchbook and reopen it. It does that every now and then. It just crashes for no reason, and then you have to reopen it twice. You reopen it, and then you close it, and then you reopen it, and it clears everything out. I'm back. Anyways, you go to treasury.gov. Right, I've shown you that before, treasury.gov, and there's a long menu here, and there's data over here. Click on data, you get a menu that pops down, and the very first one you click on. Our Fed officials, is it through supply and demand or something from the market? I think you were asking, how do we come up, how are they determined? The buying and selling of bonds in the market is what determines what the par rate will be. Are Fed officials restricted in investing in the market? No, but they do have to, I think there are not windows, but they have to telegraph well in advance of when they're going to buy and when they're going to sell. Or there might even be, there might be some restrictions now, being that you've had some issues in the past. I'm not up to speed on that. Being short SPY has been so hard this year. Yeah. You're singing to the choir, my friend. It's felt like surely the market has to go down. It hasn't. I've been rolling over my long puts to stay in the long puts. That's costly. To stay in the game to catch some downward moves. Luckily, I've done so without taking much losses so far. Current expires are for September, December. What if now the Fed pauses or cuts, and then it's a big rally? Well, they're not going to cut. Unless something breaks. And if something breaks, it's going to be hard to get a big rally as something's breaking. A pause is more likely, but a pause is going to, over time, weigh on the market. No matter what goes on, the real economy is operating in the background. And we know that credit is harder to get. We've already seen reports on this. Credit is tighter to get. So it's that becomes the growth engine. And companies have earnings to report. If you have inflation that is coming down, well, what is inflation? Right? Inflation is prices, right? And what is revenue? Price times quantity. Well, if you have prices coming down, what's going on with revenues? Right? So I don't know why all the excitement about just, the Fed's going to pause. That's all we care about right now. Is when you're thinking about the present value of a stream of cash flows, which is the price that we see in the market for a stock, you have numerators and you have denominators, right? Well, everyone seems to be really focused on just this aspect of the denominator. This is risk-free, plus there'll be some equity risk premium, some other interest rate added on to that. Well, this is too narrow, and everyone seems to be focused on just this part. The Fed is going to cut rates, but they're only going to cut rates if the economy really needs it, which means your numerator is going to be dropping as well. But the market seems to saying, ignore this, let's just pay attention to this one little thing, and anything that suggests that we're done hiking, yay, and without thinking through everything else. And this is the problem with the market in choppy times like this. Is they look at just the very next data point, and that's it. And if there is any bullishness in that next data point, they will only look at that part of that data point, because hope dies last. You have to get rid of hope first before reality shows up. So yeah, it is frustrating being short, and I would like nothing more than to finally be done with being short. I'd like nothing more, but I can't go long because I just don't believe it. And I know the moment I give up on my short position and go long without a recession, it's going to be the wrong thing to do. So I have the conviction to hold. Timing a potential sell-off now seems so complicated when before it seemed easy. How do you think about this right now? Well, I think that reality will just show up. You have a lot of data that's showing up, and whenever there's a lot of uncertainty, markets are have very high levels of uncertainty at turning points, and we've never had this kind of inversion before without a recession. Leading economic indicators have never turned down this far without a recession. PMIs have never dropped down this far without a recession. You have so many economic indicators that say you've never gotten away from any of this stuff without a recession, that to suddenly not have a recession, and with all of the choppy data and the heightened uncertainty, for it not to be a turning point into a recession would be a world record. It would make the history books. Economic textbooks would have to be rewritten to try to explain what happened here. It would fly in the face of almost all empirical observation and economic theory. I'm betting on that, and I'm just going to stay put. Has your conviction for TLT changed much since last year? Nope. No. A recession will send TLT up. I still think a recession is coming, so I would not stand in the way of duration. Seems like it must now that you've entered a bull spread. I entered a bull spread because I thought I could capture something there. So I was selling puts and TLT was going up. And I thought, well, I had the 110 calls, which were positive, and I thought, 110, sorry. Well, let's sell the 115s because there's no money in the puts right now. I'll sell the 115 calls, and when this comes down, I'll take my profit here. That never happened, so I ended up with a bull spread, which only makes it a little bit more aggressive for me to sell puts. So if TLT starts doing this, I roll up my puts. I can keep rolling up my puts, keep rolling them up. That's not a problem. So I'm not too concerned. I'm looking today at the 104, May 104 puts. I could have gotten them earlier for $1.30, $1.20 or $1.30, I think, on the 104s. I didn't like that number. I'm going to wait a little bit longer. I'm going to see if I can get 150, 160. If not, I may go to the 105s and pick up the 105s, but I'll probably do something, but I'm waiting for Fed minutes. It's 12:44 right now, so I'll see what the minutes have. I think the minutes are going to signal some dovishness. And the market is probably going to react positively to that. And, if it does, we'll see what happens. Then I won't be able to get any puts on TLT. But I will probably be able to short some other things that I've been looking at shorting. If the dovishness isn't there, then rates are going to go up. TLT will come down. That will be my cue to be able to add more puts. Could you please explain how it is possible that your SPY position break-even is 33? Oh, that's easy enough. Okay, so not 33, sorry, 43. It is 43. So I sold a 41.70 call, because this question I've had twice, for 124.50. By the way, I was able to cover that, and I sold it again for 126, and I was able to cover that at 116, and I'm looking to sell it again today at 130. You got to be tactical when you're short. You have to be tactical. So I'm looking to add it again at 130. But if you take 41.70 and add 41.24, you get 42.94.50, right? Because that's the strike price, but I got paid that much. So my break even is basically sitting at 4,300. Isn't that nice? Are you decreasing your short positions gradually when the index falls, or do you wait before taking full profit? Nope. You got to be tactical when you're short. You have to be. You can't just wait. It's not a short and hold. You got to trade in and around it. You got to be willing to increase your short position when the market goes up. You got to be willing to decrease it when it goes down. Increase it when it goes up. Decrease it when it goes down. You have to be tactical. I've seen you focus on your portfolio theta exposure very often. Could you please explain why it is important to have theta about 1% of your portfolio? 1% is aggressive. 1% is a professional. You know what you're doing when you're targeting 1%, okay? 1% is a risk management level. Because when you do something that works, you start to get excited and you want to do more and more and more of it. Well, how do you know when it's too much? You set some percentage of your portfolio for theta. Now, as an option is getting closer to expiration, theta decay will increase, but gamma risk will increase. So if you set your theta to be 0.2% of your portfolio and bang, you hit 0.2% of your portfolio, you know to close this position and open another position because your gamma risk is increasing. So if you manage your theta risk to stay around 0.2, every time it hits 0.2, you rebalance. If your gamma risk threshold is down here, you'll always be rebalancing at your gamma risk threshold as well, so that you don't get messed up if the market moves crazy the week before expiration. Would younger Mark Meldrum consider moving abroad for better job earnings prospects if he was living in a post-Soviet country? It's hard to say. That if you say, well, what if you grew up in a different environment? Well, then I would have a different mindset. I would have a different outlook. I would not have the same view of the world that I have today. I may have a different view of the world. So it's hard to say if I would. However, being here, the right question is, would Mark Meldrum right now move to a post-Soviet country? Absolutely not. Just the lack of ability to be entrepreneurial. The lack of ability to be individual, to find your individuality and to be an individual apart from society, in a society that's supportive and safe, then no, I don't think that I would do that. So I wouldn't go the other way. That's probably the better answer. Would the new applied series be relevant for students who live in Asia? Well, the applied series has three streams to it, right? It breaks down into three groups. There's applied asset management, which is your options, your futures, and the Forex when I get that done. There is applied economic analysis, which is top-down, and your sectors. Well, that's global, right? And then there's applied financial analysis, which is just starting out now. I've got some bottom-up stuff in there right now, but it's really going to expand in the fall. Well, that is useful everywhere. The asset management one, you may not have a very good options market or a very good futures market, but you'll have some equity market, you'll have some fixed income market, you'll have something there, and everyone has Forex, or at least access to Forex. So economic analysis will work anywhere. Financial analysis will work anywhere, but you may not have as liquid a market as you would like. But if you have a broker, no matter where you are, like Interactive Brokers, that gives you access to world markets, you simply just trade the US market, the most liquid market in the world. I think it represents, like, is it 60 or 70% of all of the tradable assets in the world are in the US market. I don't know the number. I know it's huge. Could you explain exactly how the Fed balance sheet runoff takes money out of the system? Yeah, so whenever the Fed buys something, it puts money in the system, right? So let's say that it buys Treasury. Now, it can buy Treasuries from the Treasury directly. And if it buys Treasuries from the Treasury directly, the Treasury sells it and it gets money, and it goes and it spends that money. That means that there's another investor over here that can't buy that bond, that would have bought that bond, gave money to the Treasury, but can't because the Fed did. So this investor goes and spends it somewhere else and maybe buys a bond that was from another investor, and that investor then may go and spend that money. So it's basically putting money into the system. If you get that concept, just reverse it. If the Fed is not buying the security from the Treasury, it's not rolling over, then the Treasury will take this person's money. Well, that money is coming out of the economy in that sense, because you don't have this person investing here and the Fed buying. You only have one flow of money. So it reduces the amount of money in the economy. If you're short call options on ES, Do you have some sort of double theta play? Yeah, well, I know what you're asking here. Yes, I do. Okay, so here's how this works. You have SPX. This is spot, by the way. That's spot SPX, how it trades every day. The futures is the spot carried to the end of the term. Actually, a better way of doing that is R minus Q T. When R is greater than Q, the forward price will be greater than the spot price, so the forward price is up here somewhere. So on a stock, you have a forward curve for a stock, and the options are centered around the forward curve. For futures, it looks like this, right? So you have the distance between what the futures price is and the spot SPX, that's called the carry. And then when you sell a call, you have the premium. So yes, it is double carries because SPX is here. There is a certain amount of carry just to get to the futures price, and I sold the call at the futures price, which gives me the premium on top of that. So yes, I do get double, sort of double on that, just because of the way that options are centered around the futures price. And the futures already have carry in it, and there's already premium in the options. Isn't that beautiful? Let's see, how do you calculate theta 0.4345? Well, take whatever theta you have. Let's say that it is a 0.9, and then you just multiply it by 50. Whatever, you know, if you take 50, because this theta will be per unit of the underlying. The contract is for 50 times the underlying. That equals 45. There's how you get your theta. You just multiply it by the number. From my understanding, theta ranges from -1 to 1. Nope, there is no positive theta. Theta is always negative. So it's not a correlation. Correlation ranges from -1 to 1. Let's see. Can you explain in detail the difference of the option expiring with an underlying contract due in the future? Okay, and then it just ends. I can't see. YouTube does this every now and then. For this one, if you have the applied series, go into the futures folder, and there's both the equity and the treasury futures. Look at the equity futures, and I explain how the futures are calculated and where the carry comes from, and then I explain options on futures and how to identify which underlying is under which option. Sticky inflation. Sticky means it doesn't go away very easily, like labor. You know, food prices can go up, food prices can come down. Wages can go up, they don't come down that easily. That means they're sticky. They kind of hang. Once you raise wages to $20 an hour, they kind of hang out at $20 an hour. You can't 6 months later say to that person, wages are coming down, I'm going to lower your wage to $18 an hour now. They go up, but they don't come down. I'm interested in your applied series bundle. Do you cover how to add a position in a portfolio and calculate portfolio volatility, beta, etc.? Yeah, you can do that with, well, there was a reply here. Anybody interested in that can read the reply. ChatGPT tutorial. Am I training ChatGPT here? I don't know. I think it's somebody using a name. Curious on your thoughts on the historic highs of 0 days to expiration options. It's gambling. That's all it is. It's when you are playing an option with 0 days to expiration, it is gambling, because the shorter your time frame, the more difficult it is to forecast. You may think the longer your time frame, it is more difficult. I can have an idea of where I think the market is going over the next 2-3 quarters, or where the economy is headed over the next 2-3 quarters. But if you ask me, where's the market going to be in an hour? I got no clue. I got no clue. What's going to happen today? I got no clue. None at all. So it is really just gambling. From the previous videos from June and July, you discussed how the Fed can shape market behavior through use of narratives, and how they may downplay bullish signs to prevent the market from becoming too optimistic. However, I'm wondering if this time around it could be the opposite, where the Fed appears tough, but in reality, rate cuts are still expected by the market as priced in right now. Do you think it's possible the market is already factoring the potential for rate cuts despite the Fed's messaging? No. No, the Fed is not going to sacrifice any more credibility at all. At all. There'll be no rate cuts unless the economy forces their hand. And if the economy forces their hand, you cannot be bullish on the markets. You can't. So either get used to a higher cost of capital, which means stock prices are too high, earnings are too high, or get used to a lower cost of capital with a recession and something breaking, which means equity prices are too high. So I don't know that I would game the Fed too much at this point. I think I would take them at their word that rates are higher for longer, and they are eye on the prize, and they're going to bring it to 2%. And they're not going to cut rates too early, especially if the labor market's doing fine. If the labor market's doing fine, they're just going to hang out there and say, look, our other job is done. Strategies like bear call spreads or covered calls. Can you touch on how you would determine attractive prices for shorting options? I don't really think about it in terms of price as I do in terms of implied volatility. What's an attractive implied volatility? I'd like to see it over 60%, 70%. When you have implied volatility percentile, that is IVP, greater than 80%, that is a great time to be selling puts because you have elevated implied volatility within the options. When implied volatility is really low, the premiums aren't really that great. You want to be selling volatility in options, which means you want very high volatility. When implied volatility is very low, that's when you might want to think about strategies that involve buying options. So with low IVP, buying a bull call spread becomes really cheap. If bank deposits going to MM funds, those funds need to reinvest that into money market securities, which should drive down yield on the shorter end of the curve. Or we don't see that apart from 1 month rate. Well, the money market funds can always access reverse repo at 4.8%. So there's not that much desire to crowd into T-bills on the short end when you can get 4.8 in a reverse repo, which is why the reverse repo is elevated at over $2 trillion. Does it mean all these bank deposits going into just 1 month U.S. bills? Especially if the money is to stay there for, and again I lose the rest of the comment. Well, banks also have money market funds as well, right? So it's not as if money is leaving the bank altogether, it's leaving deposits. So money is coming out of deposits, but it may still stay in the same bank. So if you're at Bank of America and you say, well, I want to move my money into money market funds, Bank of America probably manages some money market funds as it is, or owns some company somewhere, part of its overall banking operations, that has access to money market funds on the asset management side. So your money would still stay within Bank of America, but just go to that. Now, if Bank of America's money market fund, because your money's already in Bank of America, chances are you're just going to stay in that family of funds. If they're offering 4.2%, what do they care if they crowd into a 1 month and get 4.5%? Right? Well, I mean, what do they care at that point if they do that? So they may be less. There may be less of a need to compete for funds because they already have you as a depositor. I know that my bank, TD Bank, called me and asked me if I wanted to put my money into something and offered me a rate. Because I wasn't doing anything. So rather than wait for me to discover something else on my own, they were proactive in calling their own customers, seeing if they could attract some of that money into their own term deposits and money market funds. So it's not that money is leaving the banks, it's money is leaving the deposits and going into and probably their own money market funds. Thank you for the update. What are your thoughts on leaps? And what instance would you consider them superior to selling deep in the money puts? Superior to selling deep in the money puts. I'm not getting the comparison between those two. I'm not talking in general, but in a particular instance where one expects a stock or ETF to trend over a 1 to 4 year period. I assume you mean trending up. Would buying deep in the money call 1.5 year out to get a hold of 100 shares and then tactically selling covered calls and puts on those positions make sense? You think something is going to trend up for the next 1 to 4 years? I would not be selling calls on top of that. if I wanted to own it, you're talking about a poor man's covered call by buying an in-the-money call option that's a leap and then selling short-dated calls against that. You can, but I would probably be more willing to sell puts against it if I thought it was trending upwards. Buying the in-the-money call to minimize the amount of time value that I'm spending and then just selling puts against it. I'd be more interested in doing that, but you're probably trying to minimize the amount of capital that you're using by selling covered calls or short-dated covered calls against that. As long as your delta is low enough, like 16 delta or 20 delta, yeah, perhaps. I live in a Gulf country, which is clearly a developing market. For example, many stocks have zero volume on any day. However, that doesn't come with higher returns. In fact, it's much worse than many of the developed stock markets. Many stocks have negative earnings, slow growth and illiquid, plus no instrument to short. It's almost the opposite of what we study. Well, when we it's not just illiquidity. It's not just, well, if we find something illiquid, it should offer a higher return. Chances are it's offering a higher potential return because if it is that illiquid, it probably has a very large required rate of return, a very large discount rate. That's no guarantee it's going to make that money. It just means it just is being discounted with a higher required rate of return. It's just an environment that doesn't support growth. Is it because of the high production, high reserves of oil, and small population addition to the currency being pegged with U.S. so it's considered financially stable, and this could justify this unattractive market? No, it just could mean it's an unattractive market, right? I mean, I have, let's have a good example of something. I have some coasters that I've owned for 30 years, extremely illiquid in the sense that they don't trade. That doesn't mean they're worth a lot of money. You know, I mean, just means they're not worth anything. That's why they're illiquid. Reposting question from previous Outlook. Okay, 3 parts. Something you mentioned got me thinking. You mentioned that 30% or so of S&P's weighting is tech. I took a look at SPY. Of the top 10 holdings, 8 of those are tech companies, which represent 27.19 of the weight of SPY. And then took a look at their PE. Okay, so you're looking at trailing PEs, 28, 32, 143, 159. Yeah, those are trailings. Versus 8 for both XOM and BRB. Where I'm getting is this is possible that we have elevated PE. I think I get where you're going. If you take out like those 10 stocks, is the forward PE on what's left far more attractive? Well, what if it was? It doesn't matter because we don't have the S&P 490, we have the S&P 500. And if they're in the 500, their forward earnings make the index trade where it's going to trade. The forward earnings, if we think about the economy that we're going to have, if you think the forward earnings are too high, even for the other companies, even if they stay at 8 or 10 times forward earnings, if the forward earnings are lower, you're certainly not going to say, oh, I'll pay 12 now. And then if they got even lower, you certainly wouldn't say, oh, I'll pay 15 now, even though I know the market's been doing that lately, saying, oh, earnings are going down, I'm willing to pay a higher price for that. But if it's not so much that I would say, oh, well, hang on a second now, if we adjust for the 10, the remaining have a lower forward multiple or trailing multiple, let's say. It's a matter of the environment we're going in. If I think earnings are just going to be doing this, I'm certainly not going to pay a higher and higher multiple for it. Even if I decide, well, I'm not going to pay a higher multiple, but I'll pay the same multiple if they're going down, then prices have to go down. So I get where you're going with that, and it's an interesting way to look at things is to take out one of them, but keep in mind, these here are trailing earnings, not forward earnings. Could you please explain how you're calculating minimum and maximum gain in your TLT position? Yeah, so I bought calls, and I started selling puts against those calls, which kept lowering my average price to the point where I got to, I think, 410, and then I sold I think it was 425. I had 410 left to recover on the 110 calls, and I sold the 115 calls for 425, which gave me automatically I win, right? Because I bought and I sold, so automatically you win. And then I just kept working this down. My goal is to get that to 0 so that, you know, I win. I think I got about another buck to go on that. I don't have very far to go on that. So worst case scenario right now, if these both expire worthless, I still walk away with 17.4. Just by working down the premiums on the calls that I bought. I still walk away with 17.4. This is a $5 spread times 6,000. That's a potential other 30K. If it finishes at, let's say, 116, I get the full spread. So heads I win, tails I win. I can't lose right now, which means I have 17.4 of the house's money to play with, so I can get aggressive in selling puts on TLT if I want to move up from 104 to 105 or even 106 on selling the puts. Does this mean you can't lose on your TLT trade? Nope, cannot lose right now. What if TLT goes to 80, 90? Can't lose unless I sold a put. If I sold a put and it goes to 80 or 90, then yeah, I'll lose. Doing your applied series, and I'm wondering if you're strongly bearish, why are you selling calls instead of buying puts? Because I get the difference between the spot price of SPX and the futures price, and since I'm selling a call on the futures price, I get the premium, so I get huge spread between the two. That's why I'm doing it. And it is, I have short positions. I am short ES. But selling calls is just a way to add, maybe I don't want to add, you know, more ES. Maybe I just want to add enough delta at certain points. So that's all I'm doing. With a recession, low growth environment ahead, would not tech NASDAQ be a good place to be? Well, with a recession and low growth environment ahead, I don't want to be anywhere. Also, where do you see opportunities in the fixed income space besides TLT? Right now, the only opportunities is either very short-term money market rates, because that's pretty much guaranteed. If you buy a 3-month discount bond at let's say 97.8, in 3 months it'll mature at 100. That's pretty much guaranteed. I wouldn't touch credit right now, only because credit spreads would expand in a recession. Duration is really the only thing, but you can get duration from the futures, you can get duration from TLT. Would you be able to give a history lesson that you know about PE multiple evolving from low single number to long-term average of 16.6? I think this is directly due to interest rate, but like to hear your thoughts. I don't have the history to get that done, so I'll pass on that. What's your thoughts on M2 and momentum on equity markets? Well, M2 is shrinking, right? When I place M2 chart from Fred and S&P momentum index side by side for past 10 years, high correlation. I don't know what you mean by an S&P momentum index. I don't know what you mean by a momentum index. I mean, there's the price index, but that's not a momentum index. So I don't know if you're looking at something called momentum is the rate of change in the speed of something. So I don't know what these things are. I don't know what these things are. But there is a correlation between M2 and the S&P 500, the level of M2 and the price. I don't know about momentum. No. Have you thought about taking into consideration the increasing sentiment against the dollar towards the yuan? We have seen China sway its influence over the Saudis. Well, again, I'm going to say it the same way I said it before. The economy is facing a credit crisis. Things are falling apart. You need to put your money somewhere safe. Are you going to lend it to the Communist Party in China? That's it, period. And if your answer is yes, well, then have at it. If your answer, well, no, well, there you go. That's what everyone thinks. You can either give it to the U.S. Treasury or you can lend it to the Communist Party in China. Who do you want to hang on to your money for you? Any thoughts on Bank of New Zealand surprising the market with 50 basis point rate hike? Not really. I'm not up to speed on where the New Zealand economy is, so I can't really comment on that. Can you show us the source for U.S. corporate IG and high yield? You can get that at coifin.com. Same thing, the OAS spread. Or you can just go to Google, type in high yield OAS Fred, and you'll get the spread. Then just change this to IG, change that to double A, change that to triple C, change that to double B, change that to triple B. with the same thing here, and you'll get a long-term chart up for each of them. So you can look at where they stand today versus history. The IG the 3-year IG, quite fin. Oops, let's get that back here, down here. Share your thoughts on a strategy where you buy a share before it goes ex-dividend and sell it afterwards. Same time sell a cover call. Oh, I answered that. There would be no difference between that, because the call, if there was a dividend during a period in which before the expiration of the call would reflect the dividend, because the price of the stock would drop. So the call would already be priced to reflect the dividend, such that the premium that you're getting would be the same as if there were no dividend. So there is no strategy there. Quick video just showing how to buy 1 to 3 month T-bills on IBKR. Yeah, I could. I'll do that for the next Sunday market outlook. I'll just show very quickly on how you can buy a treasury. You should buy bill ETF 3-month T-bill pays monthly dividends. Okay. A quick recap of your overall trade on TLT. Besides a bull call spread, how did you manage to create a minimum gain of 17? Was it selling puts and rolling on the way up? It was selling puts again and again and again. Every time it sold off, I sold puts. It would rally, I'd cover. It would sell off, I'd sell puts. It would rally, I would cover. You're slowly working off the premium that you use to buy the calls. Will you do an applied series on commodities? Yep, this fall, energy commodities are first. During late February to about June, I have to do CFA content because I still do that. And the new stuff is out for 2024. We get it early. May 16th, level 1, level 3 launches 2024. You got to get that ready in time. So there is no time to do anything else. But once it's up, then you're good. Then I can turn my attention back to the applied series. So applied series I work on from like August to February, and then CFA is from like February to July, June, July. 20% in metals and mining. Is there an ETF for that? XME? Yeah, you can. Well, XME is just the US. It's the components of the S&P 500. Not that excited about it. PIC is a good one. If you're looking for just copper, there's CPER or COPX. There's some good ETFs for that, but PIC is a good one. Or you could just go right into the mining companies. Is it possible to roll a vertical spread until there's zero risk? Zero risk? You mean get it for free? I guess it's possible, but is it probable? It depends on what the underlying is doing. I'm not enough information there for me to answer. There's a difference between probable and possible, right? Anything's possible, but is it probable? Depends on the underlying. It's widely accepted that the efficient way to implement portfolio 60/40, provided I'm willing to higher levels of risk, is the best lazy portfolio simply a levered 60/40. Levered, just 60/40. Sure, you can do better than the 60/40. You can always do better than the 60/40 if you have options and you're willing to use the options on risk management. You can always do better than the 60/40. 60/40 is for the passive individual who really doesn't want to get involved in looking for sources of extra return, is just happy with the 60/40. How about the title? What bank failures? I should have said that. What bank failures? It's a good one. I didn't have a title, so I just wrote title pending. And that is my title. It wasn't like I put the word title pending, meaning I'll come up with a title. I was actually going to put I had rice and pork for lunch. And if somebody asked me about the title, I would have said, well, I couldn't think of a title, but I did have pork and rice for lunch, and it seemed like just as good a title as anything else to put up. I really didn't have a title for this week. So, and I think the title pending plays on the fact that we have so many risk events this week that I don't know what the title is, But next week I know what the title will be. Can someone please explain why Mark looks at par rates and not the regular Treasury yield curve? The Treasury yield curve you look at whenever you hear yields quoted in the financial news, those are par rates. You mentioned that you will be listening to JP Morgan call. Is that something you need special permission to access? Nope. Go in any company, go to investor relations on either in the morning, whenever they say their press conference is, You can go to Investor Relations. There'll be a link to the webcast. You click on that and you hear it over the web. Now, you can't ask questions because you're not on the call, but you are listening to the call. You're listening to the webcast. And you can listen to all of them. It's not as if you need to listen to it at that time. It's made available for listening later. In fact, if you go to JP Morgan, you can listen. I would do this. Listen to their earnings call last quarter first, just to hear what they're saying last quarter, then listen to this quarter. And has anything changed? Has the tone changed? Are they saying the same thing? Has the strategy changed? Xerxes, Kashkaria Xerxes. Listen, I challenge you to do that. The movie 300. Google it and look up, get a picture of Xerxes. Then put it side by side with Kashkari. Tell me those aren't the same people. I'm sure that was Kashkari who was in 300 playing Xerxes. You got something wrong in your Q&A. You said that AI cannot outperform in strategic intuition-based games like poker. In fact, there are AI poker bots that have beat the very best in the world over a statistically significant sample size. Oh, well, I stand corrected. AI has solved six-handed and 1 versus 1 poker. How do you reflect on AI replacing portfolio managers, and it drifts away? There was a story on Bloomberg, not on Bloomberg, sorry. It was in my news feed today saying AI still can't beat the market. And there was a story about, I didn't read the whole thing, but it was just AI still can't beat the market. I think that is true. If you train data on history and expect it to beat the market, I think it will continue to, if you train it on history, it will continue to play history. And I think it would have a hard time spotting regime changes. If the forward curve 18 months from now is indicating interest rate cuts, do you think it is ironic, keeping in mind that inflation is still pretty high and the Fed should keep rates where they are, at least for a good year, to get inflation down? Yeah, well, I don't know that I would call that ironic in that sense. I would call that misguided. Since markets look ahead, do you think Infotech outperformed Q1 in Canada and the U.S. due to expectations of lower cuts? Probably. The performance of markets in the first quarter was purely multiple expansion. It wasn't earnings expansion. It was multiple expansion. Earnings were contracting. The estimate for forward earnings were contracting, but prices were going up. It was purely multiple expansion. It was purely the market saying, I'm willing to pay more for each and every dollar of earnings, no matter what they are. I want to pay a higher multiple. It was purely multiple expansion. No real catalyst factor except for cutting jobs, which would lead to higher net profits. That was a lot of it. Well, if you're cutting jobs, that's one way to get higher EPS. But it's not a sustainable way because you can only cut so much. Layoffs are events. They're not trends. They're events. Increasing revenues are trends. You invest in that, but layoffs are an event. You get a one-time boost. Maybe you see it show up over a couple of quarters, but it's a one-time thing you get to do, unless you can keep laying off people. But at some point, you got to be suspicious if the company you're invested in just keeps shedding people again and again. Let's see, December 24, December 23. Is it 3 month or 1 month? I believe I used 1 month to get that done. I checked Chatham Financial. Is it 3 month? No, it's 1 month. 1 month. Not in my backyard, alive and well in Australia. Well, it's alive and well in the human population. It's not like it's country specific. There seems to be, in the last few years, this absolute willingness by otherwise progressive people to sort of give, the human condition only to certain groups of people. Oh, these people suffer from this condition. This group of people or this gender suffers from this human condition. Everything they're describing is a human condition. It's not a skin pigmented condition or a gender condition or a sexual orientation condition. It's a human condition. NIMBY is a human condition. Everybody has ideas for how to make the world better, but not in my backyard. We should have more nuclear, but not in my backyard. Well, what we need is another wastewater processing plant. But hey, I live on the lake. Don't put it where I can see it or smell it. Put it over there. Put it in their neighborhood. We need more immigrants, but I don't want them in my neighborhood. Put them in that neighborhood. That is a human condition, by the way. So alive and well in Australia, Canada, US, UK, where immigration-led population growth is the preferred method of absolute GDP growth. It's an easy way of achieving GDP growth. Productivity is hard. Why not just bring in more hands to do stuff? Yeah. Solves for labor shortages too. Never mind bringing in more people shrinks GDP per capita. Has the potential. If you don't do immigration correctly, it does have the real potential of shrinking GDP per capita. I will say that. If you have merit-based immigration where you say, and the U.S. has this, by the way, they have an open-door policy for PhDs. That if you have a PhD, especially a scientific-based PhD, it is an open-door policy. And if you got your PhD from an American school, it is front-of-the-line open-door policy, 3 months. So I have an American PhD, and I have the investment threshold met as well because of the money that I would bring in. That if I move to the U.S., I'm front of the line. For green card, it would take me 3 months and I'd be in. That does not lower GDP per capita. That raises GDP per capita. However, here is the problem. Let's say that you have that type of immigration policy and that's it. Well, I show up here and I say, but what about my family? If you don't allow me to import my family, I have less desire to be in your country because I'll be all alone. So you have to say, well, if we're going to get the biology and the chemistry PhDs here, well, I guess we got to open the door for their family as well. So that opens the door to more coming in. Well, if you open the door for family and I bring somebody in who is not productive and they get their citizenship, they are now capable of importing somebody as well who is family. And it's that second and third effect that, well, what can you do? You can't have different rules. You have to say, well, this is what we're looking at. So you can have proportions. You can say a certain proportion of our immigration must come from merit-based. Another proportion could come from family-based. And it might be 50-50. So that if you say, well, I want to bring, my grandfather in, it could be, well, we've hit our threshold for this year. So it's not always the case that it lowers GDP per capita. Dilutes access to social services and infrastructure, which don't tend to keep pace as new entrants arrive. And I will say, yes, there are North American neighborhoods that were not designed for Eastern-type family structures. So an Eastern-type family structure is not uncommon to have multiple generations in the same household. That's not uncommon at all. In fact, it's seen as an obligation. Whereas Western-style families do not have that. That neighborhoods were built with a certain density assumption in mind that each house might have 3 to 4 people, not 8 to 10 people. So, yeah, infrastructure has to be rethought in terms of not just a North American or a Western-style neighborhood any longer. Can we blame NIMBYs? Perhaps the movement simply needs to be less provincial and lobby higher levels of government to prioritize the interests of citizens in a broader sense over the government and businesses who selfishly adore more taxpayers, consumers, workers. I don't know how to answer that. It's Kashkari's argument that he made for housing is that there is lots of places to build houses, but that there's so many zoning restrictions, and a lot of those zoning restrictions are driven by the very residents in those neighborhoods, which he has a point on. There are restrictions on what you can and cannot do. Now, if you look at where I live, the city has a certain building requirement now called a 30-30, which means increase the size of the city by 30%, but increase the density by 30% as well. Which means you cannot build on big lots. Whether you want to or not, you cannot. If you have a big lot that they say, well, that's a 3-house lot. You can't just build one big house on that anymore if you're a developer. So there are policies at the city level that override what any one particular individual would have to say. So you do have those sort of things coming in. But if you have a demographic, an upside-down demographic and a shrinking population, and birth rates are not going to get it done, What are you going to do? Do you just say, no, we're going to hold the course until the last person dies and then the land is free to claim from any other country? I mean, you get to the point where your population is so small that you're not even a country anymore. So if that's the case, you're going to hand your land over to somebody else in the future anyways. Why not start the transition now? You know, I'm not seeing the problem in it. I do see the problem when you have anchor cities that are huge attractors. So, for example, in Canada, Vancouver, Montreal, Toronto are the big centers where, when you have immigration, they tend to land in those three cities because there's big communities from their particular countries. That puts a huge strain on those particular cities. That you could probably have a better immigration policy by saying, fine, we'll let in these people, but have a geographically restricted immigration policy saying that these three centers are closed for immigration. How do you police that though, right? You know, you could say, okay, well, I'll go to Sudbury, and you land in Sudbury. 6 months later, you move to Toronto. Well, who's going to know? So, you know, I think with this sort of thing is there are problems in moving forward, but there are problems in going backwards. You know, it's which problems do you want to solve? I think the problems moving forward are the easier ones to solve. Did you close ABR? Nope. Do you still have your short 4075 calls open? Yes, I do. Are you Central Time? I'm Eastern Time. Did you see the bordel in the New York Fed? And I had to ask somebody, this is a French term for chaos. I don't know what chaos there is. I asked for clarification, got nothing. What changed with car.un? Just apartments in general. I just can't see the upside anymore. I'm not bearish. I'm not shorting apartments. I just don't see the upside, which means I'm really holding it just for the dividend yield. And if I'm going to be holding an apartment REIT that has a 3.6% dividend yield or a 4.5% dividend yield, a 6 month has a 5%. I'll take the 6 month treasury. Thank you. It has a higher dividend than apartment REITs, so I'll take that. Sunday session Eastern Time. Koifin also introduced their own financial chatbot. Did you try it? No, I did not. I would like to hear your comments, so I didn't try it. And that wraps us up. It is 1:28 on a Wednesday. I wanted to finish by 1:30 because we have the minutes at 2 o'clock. And I will have a video out, particularly just for the minutes, whether I'll get it up tonight or tomorrow morning. I will have a video out just going over the minutes, and that's it. Ciao.